Alright, hi everybody. Today we are going to talk about the stock of Uber. Stock of Uber is down something like 26%, was down 30% at one point, and a lot of people are talking about a potential investment in Uber and the attractive long-term returns this investment could provide. Is this really the case, and is Uber the lord of a future autonomous driving world? We'll discuss this in this video, so without further ado, let's get started. Alright, hi there. Basically, we're going to cover a bunch of different things in this video. I'm going to give you an overview of Uber's business and what makes it so unique. I'm going to take a look at the financials of the company, show you how Uber has more recently turned into a quote-unquote free cash flow generating machine. I consider the threat that comes with the transition to autonomous driving, but also the opportunity that this transition may present for Uber specifically. And finally, I'll do some valuation work, value Uber stock based on some assumptions that I find realistic. So without further ado, let's take a look at the overview. So as already highlighted in the introduction of the video, the stock of Uber has come under pressure more recently, and that's mainly due to concerns about AVs, so autonomous vehicles. And I would argue especially Waymo, so that's Google's AV solution, expanding its fleet to more and more cities and areas across the United States. Yeah, and obviously this transition to an AV-dominated world poses risks to Uber. And there's a lot of uncertainty what kind of role Uber is going to play in this new world of mobility. Are they still going to be the dominant platform that everyone needs to go to if they want to access mobility solutions? Or are Google and Tesla as well going to be able to develop their own platforms via which consumers will be able to access their AVs? Which of course would be the much more lucrative option for these two companies, because then they don't have to give away margin to Uber. But we'll get to that in a second. So first of all, what does Uber actually do? Well, Uber Technologies operates a global technology platform that is basically connecting consumers on the one end with a variety of on-demand mobility, transportation, or delivery services. And as I will show you in a second, the business of Uber can basically be divided into three main segments. We've got mobility, delivery, and freight. I guess what's also worth pointing out is that Uber itself doesn't own any cars. It doesn't own the fleet they use to provide their mobility services. No, instead, their business model rides on taking a commission on each ride that is booked via their Uber app. So generally speaking, and that is something that I personally find quite attractive about Uber's business model, it is asset light. It doesn't require a lot of capital to gain global scale. And the company was able to gain global scale relatively quickly. And they are now very focused on the technology side of things and the user experience in the app. So just to back up what I was just saying, I was including a tweet here from Bourbon Capital. He wrote, "Uber is a money machine for doing nothing. A third-party contractor does the job, and it will keep growing with this business model." However, what's also important to be aware of as an Uber investor or potential future Uber investor is that with this model come risks, and especially in the form of some of the legal challenges that Uber has to deal with. So the question basically here is, can Uber drivers really be considered contractors, or should they rather be considered employees, which would require Uber to treat them differently, which would of course disrupt Uber's advantage of just being a platform. But we'll get to these risks a little later again. So I was just saying we can divide the business of Uber into three segments. Let me just give you some numbers here to get a better overview of how important each segment is to Uber's overall business. And now we're looking at the gross booking. So that's basically the amount customers or clients pay Uber via the app. Mobility, as of today, represents around half of Uber's total gross bookings. Then we've got delivery, which represents 44% of all gross bookings. And then we got freight, which is one of the less important segment, or the least important segment for Uber, which only accounts for around 4% of the total gross bookings. And I guess most people will probably have used an Uber in the past, so you will probably understand how the app works. But generally speaking, what's important to be aware of is that, of course, the algorithm is going to match you with a driver that is nearby. All of this happens via the Uber app. And then there's also the feature of dynamic pricing that you have to be aware of. So depending on how strong the demand is at the moment, you want to book an Uber and how strong the supply is, you will have to pay more or less given at what time you want to take that ride. Are you going to take it on a Saturday evening? Then of course the ride is going to be more expensive because demand will be very high compared to say a Monday morning, 6 in the morning. Then you will probably pay significantly less for the same route. And yeah, just wanted to wrap up this overview part by showing you this illustration by Dr. Gary Fox, which I think is incredibly helpful when it comes to understanding Uber's business. What I sort of circled in the middle was that Uber basically is a platform. And that's also one of the, again, competitive advantages of Uber. Once they have onboarded a user, they can cross-sell some of the other services to that customer. And that, of course, makes customer acquisition costs lower for Uber compared to some of their competitors. And it will also increase the customer lifetime value of that individual. What I will also say, speaking of the 3 different segments here, is I'm not sure if Uber, to succeed and to be a successful investment, really needs the freight segment. I was listening to a business breakdowns episode on Uber that is, I think, 4 to 5 years old today. But nonetheless, back then, the guests that are very familiar with Uber's business already highlighted, and I think that's still true today, that having this segment bears the risk that the management team might lose focus. I think Uber as an investment can do very well if they exclusively focus on mobility and the delivery segment. I wouldn't even mind. And just for full transparency, I'm not a Uber shareholder as of today, but if I were one, I wouldn't mind if they would just leave the freight segment, the freight business altogether. Then again, just to provide some more numbers. So the platform that I was just talking about, as of today, facilitates around 2.9 billion trips per quarter. That's an insanely large number, and that is as of Q3 2024. So this means they average around 31 million trips per day. What makes Uber's business also unique and competitively advantaged is it's basically a network. It's a two-sided network with drivers on the one end of the spectrum and the consumers on the other end. And again, just to add some context here and add some numbers to that, as of today, Uber has around 161 million monthly active platform consumers. And that number is up around 13% year over year. Again, as of Q3 2024. And then on the other side, you have 7.8 million active drivers and couriers globally. And I found this chart here from the blog The Wolf of Hardcore Street, which illustrates quite nicely how the number of active platform users has been growing steadily over time and has been growing at quite a decent mid-teens rate in the more recent quarters. And the same is true for the number of trips, which has even grown at a faster rate. So that's an important KPI, so key performance indicator to track as well. What I will say, however, with regard to the network effects that Uber benefits from, it's not as strong as the network effects you might see in other businesses. And that's because the network effects are localized, meaning, let's say you live in a city in Germany, where I live. Once a certain number of Uber drivers are available in that city, I don't benefit from any other riders joining that network in that city. And I don't enjoy any benefits from Uber adding new drivers in other regions in Germany or across the globe. So it's a very localized network effect, which makes it easier to disrupt than a network effect business that benefits from each additional user of that network. So that's another part I read in a blog, and I'm going to include a screenshot here. So part of Uber's problem here is the fact that users of ride-sharing apps don't really tend to have much loyalty or care about which service they're using. Only 34% of customers use both Uber and Lyft. 2/3 of drivers drive for both apps. So as you can see, there's an overlap between different platforms, both drivers and customers. 68% of drivers stop driving within 6 months, and the churn levels are reported to be as high as 96% after year one. That's actually an insanely high number. Now, what I will also say is, and we'll get to the unit economics of Uber a little later in the video, but more recently, Uber was actually adding 2 new segments that I think are more attractive because they are higher margin segments. And those 2 would be, first of all, the advertising business, which I think has been growing at a rate of 80% year over year and has now reached a run rate, if I remember correctly, of around $1 billion. What I will say about the advertising business is that obviously Uber also benefits from having access to a ton of very valuable data. Just imagine the following. You are taking the same route to work every day. You might enjoy a coffee in the morning. So Uber could, for example, show you an ad of Starbucks that is nearby. I think that's incredibly valuable, and obviously there will be demand for that advertising product. And that's exactly what Uber is basically doing right now. They are showing you ads in their Uber app. And the other business area to be aware of is the subscription business. As of today, Uber has around 25 million Uber One members who enjoy the benefits that come with the Uber One membership, which just gives you different benefits like savings on rides or deliveries, for example. Which brings me to the financials of Uber. So I want to show you two things. First of all, you can see that the revenue of Uber has developed quite well over the last 5 years. It has compounded at a rate of 29% over the last 5 years. It also generates around 6 billion in free cash flow as of today and around 2.7 billion operating income. The margins are trending upward, as you can see in the next chart. And as I was saying in the introduction of the video, it seems like Uber is now turning into a free cash flow generating machine and is no longer burning many billions as it did in the past. And what I also want to highlight is that the management team of Uber actually announced plans to buy back shares aggressively, which I think could be taken as a signal that management is indeed optimistic about the long-term trajectory of the business. What this chart here, however, also shows is that even though Uber was generating around 6 billion in free cash flow over the last 12 months, you also have to take into account that stock-based compensation is a real cost and that Uber is handing out a lot of shares to employees. So the real true free cash flow generated by Uber over the last 12 months, I think is closer to around 4 billion, which would also mean the actual free cash flow margin generated by Uber as of today is lower than 14%. It's probably closer to, let's do the math here, probably like 9%, I guess. Now, as I said earlier, the recent poor share price performance can largely be attributed to the uncertainty that comes with the transition that we are all witnessing right now to autonomous driving. And the question here you have to ask and get right as an investor is that transition a threat or an opportunity to Uber's business? I'm going to cover both in this video. So let's start with the threat discussion. I think there's no denying that autonomous driving does represent a very real threat to Uber because the business doesn't have any technology or no longer does any technology in that space. So they will have to rely on other providers of AV solutions. And they have to bet on these providers wanting to access the consumer base of Uber, which of course is the opportunity that comes with that transition. But let's focus on the threat first. So if we take a look at Waymo, for example, to me it seems like customers in the cities where Waymo is available love that service. And while Waymo has partnered with Uber in some cities, in other cities they are also relying on other providers, or they are even providing the offering via their own solutions. And earlier I was saying that Uber basically runs a two-sided network effect. Autonomous driving, or the shift to autonomous driving, now definitely represents a risk of disruption to one side of that network effect, the drivers. So I wanted to include a tweet here by Zeph Philippine. He wrote, "CapEx costs can be brought down and scale can happen quite suddenly, especially when you don't need to recruit supply-side drivers." So what he's basically describing here is part of what makes Uber's network effect so defensible is that, and that's the nature of a two-sided marketplace, is that you need to get enough drivers, in the case of Uber, on the network and enough customers who want to book rides with these drivers. And doing this on a global scale is super hard. Historically, and that's also why Uber was burning money in the past, they were providing incentives for drivers to use the Uber app. And now if we no longer need drivers, obviously that part of the network effect is gone, which weakens the competitive position of Uber. And then he continues to write, and you have an app that can come pre-installed and in billions of devices. And I think he's mainly referring to Google, the Android operating system for mobile phones, and where Google could just have a Waymo app pre-installed on all of these devices going forward. So the question you also have to ask yourself here is, how quickly will that transition happen? I would argue it will probably still take another 10 years at least, even though we see rapid accelerations and progress in the field of AI, which of course is an important component of AV solutions. And of course, the scaling costs of developing a global fleet of AVs are going to be tremendously high. I think a Waymo car as of today costs something like $300,000. You can imagine how incredibly expensive it will be to build out this fleet, and this will naturally take time. So I'm not sure. 10 years at least would be my guess. Before that, we are not going to see a world that is dominated by AVs. And as of today, earlier I was saying, I want to give you some numbers with regard to the number of rides that Waymo provides. I think Waymo does something like 175,000 rides per week, which again, compared to the many millions of rides that Uber provides on a daily basis, I think earlier I said 31 million, is pretty negligible. Which brings me to the opportunity that may come with a transition to an AV-dominated world. A couple of points here. So first of all, and there's a beautiful chart by Uber itself, the investor relations team of Uber itself, the transition will be a quote-unquote expander of the total addressable market. So not only will it increase the number of customers, it will also increase the number of trips per customer, which of course will be beneficial to the gross booking volume that Uber handles via the app. What's also worth pointing out is, earlier I said that Waymo is already partnering with Uber in certain cities, I think in Austin and Atlanta. However, Waymo is also offering their service in other areas like Miami, for example, without Uber. So to me, it seems like Waymo, or Google in this case, is sort of experimenting right now what will work best for them. However, the network, the demand network, the demand aggregation that Uber does via their platform is certainly valuable and will be valuable for a lot of AV providers. It also seems like to me that we will probably have multiple AV providers, and I think chances are Uber is going to play a role in that world. So to me, it seems like that the AV risk is overstated right now by investors, which has led to the share price decline over the more recent weeks and months. And the opportunity that the transition to AV may provide is also something that the CFO of Uber believes in. To quote him here, "Our hope is that to the extent that Elon and Tesla build some great technology, when it's safe and ready to use, they plug it into the Uber network and we can all win together. We'd love to have it on the platform, but if not, I don't think that is going to be a winner-take-all marketplace." That's what I just said. "We believe in the spirit of partnership and we'll see what Tesla does." And there's also another chart from the investor relations team of Uber that actually shows the partnerships that they already have. And I think in total they already have, I noted it down somewhere here in my notes. Yeah, they already have partnerships with 14 different autonomous vehicle companies, which ensures that they probably will remain at the forefront of the mobility sector. And you also have to remember, now that Uber is profitable and with the transition likely taking more than 10 years, in the meantime, Uber is going to generate a ton of free cash flow, which they can use to buy back stock, to pay dividend. I guess that is something you also have to track closely. What is management now going to do with the excess cash they have? Uber, the business itself, as I said earlier, doesn't require a lot of reinvestment. So you definitely want to have management team make smart use of the cash they now have at hand. Another part that I wanted to discuss here, and I recently tweeted about this actually, and that is something where I would like to hear what you think. Is the transition to AV going to make Uber a more profitable business? Because what you have to understand is that from a unit economics point of view, Uber's business is not the most attractive business in the world. I found this excerpt, or if I decided to include this excerpt from the previously mentioned business breakdowns episode that breaks down the unit economics of the business. And I also read a blog post from the Innovestor Substack that arrived at similar numbers. Drivers of Uber represent a meaningful cost to Uber. Strictly speaking, it's not a cost. They don't report the gross bookings as the revenue of Uber. But let's say, as we can see in the table here, let's say a ride costs you $20, around $13 of that total ticket go to the rider. And I wonder, with cars being driven by algorithms basically, and that cost being gone, are the prices per ride going to decline significantly? Or if they remain similarly priced, is Uber just going to take a larger cut of that overall cost of the ride, which would make Uber a much more profitable business. There's a comment by the CFO of Uber who makes me think that they are going to try to drive the cost per ride down if AV is going to become or reach global adoption, and that they are maybe to run the scale economy shared playbook, which I think I would like to see as an investor, because this would just make Uber's business ultra defensible. Obviously, it would be less profitable, but it would be harder to compete with the business. So he said, our goal is to drive our take rate as low as possible. There are a few reasons for that. One, a low take rate creates a meaningful barrier to entry. That's what I just said. Second, a low take rate helps create internal pressure on the organization to constantly drive out costs and ensure that we are running the network as efficiently as possible. You see that in every single quarter. We report sort of a few basis points of incremental margin that we are able to extract from our cost structure by continuing to grind down those costs. Again, that reflects Uber's sort of that operational part of the organization. With that low take rate, we also need to reflect it in our insurance cost. Which brings me to the last part of this video, valuation. So what's important to understand is that the global ride-hailing market is projected to grow at a high rate. So it's projected to grow from around 80 billion in 2024 to around 140 billion in 2028. Also, to get back to the slide I showed you earlier from the investor relations department of Uber, the transition to AV is probably also going to increase the gross bookings that Uber is able to record. So what I was doing is I was running a reverse DCF to figure out what kind of growth is required for an investment in Uber to make sense right here. I was using a discount rate of 10%, which means that's the return that I'm demanding as an investor. I was using free cash flow of 4 billion. That's the free cash flow Uber generates as of today, adjusted for stock-based compensation. I was then projecting that the company grows 25% over the next 5 years, followed by 15% between year 6 and 10. Again, that's quite a high growth rate. I don't consider these growth rates conservative. Let me put it this way. I was then assuming a terminal growth rate of around 3%, and that would give me an intrinsic value of Uber of around $99 per share. However, that doesn't reflect a margin of safety yet. And as I think the trajectory of Uber is quite unclear, I think I've discussed this quite openly in this video, I would definitely want to demand a large margin of safety just to account for the fact that I might be wrong in my assessment. So these assumptions don't make Uber an attractive buy yet if you demand a 50% margin of safety. You would have to increase, and I did the math on that as well, you would have to increase the growth rate over the next 5 years, free cash flow growth rate to 35% compounded, followed by 15% compounded. And just put this into context. The 25% followed by 15%, for example, would already mean that the free cash flow generated by Uber, the 4 billion, would turn into, let me just find my number here, into 25 billion in 2035. And obviously the numbers would be even bigger. I think it would be something like 35 billion in 2035 if you would require a 35% free cash flow compounded growth between year 1 and year 5. So I think what these numbers show is that Uber as of today is not a no-brainer investment despite the more recent share price decline. This means I'm going to continue to track Uber. There's a lot to like here, but I don't think it's the best business in the world. It's certainly an above average, very high quality business, but not a business that is going to post something like 40% margins as of today. With the unit economics, business posts with human drivers, again, as of 2025. So I think what makes Uber interesting here is Uber is all about being right in that assessment. Which kind of role is Uber going to play in the AV world, which I think is like that transition is inevitable at this point. I think we are going to live in an AV world in the medium term. And what kind of role is Uber going to play in that role? And what kind of, if they play a central role, what kind of bargaining power, pricing power do they have over AV providers? If you can get that assessment right and come to the conclusion that Uber is attractively priced right now, well, obviously you might have an investment at hand right here. I haven't arrived there yet, and I'll continue to track that investment going forward. Let me know if you want me to do another video on Uber at some point in the future, and I'm going to call it a day here. Take care.